Unless you've been hiding underneath a cave for the past several months, you're aware that the Federal Reserve has been producing large sums of cash. Furthermore, the printing of money has boosted financial assets all over the board, resulting in unforeseen circumstances. Ray Dalio, the chairman and CIO of Bridgewater Associates, the world's largest hedge fund, reportedly spoke about how he believes the Federal Reserve has driven the financial markets to an edge. Dalio is a macroeconomic specialist who has successfully managed $150 billion in assets throughout the last decade. And because of his famous knowledge, countries have practically gone to Dalio for his economical analysis. This isn't simply a pitfall for the Feds, it's also a pitfall for individual investors such as you and me. This video delves into what these developments are and how the Feds has found itself in a big dilemma. But first, let me welcome you to our Smart Stocks Academy channel. The like button, subscribe, and click the notification bell next to it to be the first to learn when a new video such as this is uploaded. Now let's get to the video as quickly as possible. First and foremost, this isn't intended to become one of those doom-mongering videos warning of an impending disaster. It's nearly hard to predict market collapses. I'm also here not to instill terror as some others have attempted. With that stated, our current condition is odd, and these occurrences will have major consequences. The Federal Reserve has been imposing significant levels of monetary expansion, or the purchase of enormous sums of bonds during the last few months. The government's increased purchasing power has artificially raised bond rates. Bond rates and yields are inversely connected, as some of you may already understand. Bond yields must fall as bond prices rise. When the bond prices fall, bond yields should rise. Bond yields have been slashed to absurdly low levels as a result. The 10-year Treasury interest is currently about 1.5%. Simultaneously, the rate of inflation is easily considerably greater than 2%. Fundamentally, while bond investors may believe they would profit, the reality is that real rates are negative. At 1.5% per year, nominal returns are positive. However, real returns, which contribute for inflation, are absolutely negative. As a result, bonds are currently a joke of a financial tool. To address the artificially high bond rates, the appropriate action right now would be for the Federal Reserve to liquidate several of its bonds. We've already seen the beginning of all this. In essence, the Federal Reserve has already begun to sell corporate bonds and corporate bond exchange traded funds that it bought in the midst of the global pandemic. Furthermore, the Fed has begun to talk about decelerating bond buying. You could believe that the Fed is tapering its bond purchases based on the facts we've just seen. Ray Dalio, on the other hand, believes the Fed is in an entirely different position. He thinks that instead of selling bonds, the government will soon be obliged to buy them. That may appear absurd initially, but a closer examination reveals that it makes a lot of common sense. Bonds aren't particularly appealing right now, as I mentioned before. Big organizations have piled up government bonds to be conservative, which is one of the reasons why bond prices are so high. If the epidemic worsens, these organizations will be able to sell the bonds and continue to operate. Bond prices will plummet once these big organizations and shareholders start selling bonds to buy other financial assets such as domestic stocks, real estate, and international stocks. This is due to the fact that no one wants to buy bonds when inflation is too high because inflation assures negative real returns at the present rate. Furthermore, alternative financial assets have the capacity to realize far greater yield. To avoid the bond price fall due to the Fed's selling power, the Feds will have to buy bonds, so artificially increasing the money supply. So rather than tapering as planned, the Feds will have to keep boosting bond prices and causing an additional inflation in the financial markets. This sort of inflation is known as monetary inflation, and it occurs when the money supply consistently increases.
The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation.
You may believe that the Feds would allow bonds to fall, but the bursting of the bond bubble would have a massive effect on all other classes. Borrowing money pays off handsomely when interest rates are low. That's hardly surprising, given that interest rates around zero make borrowing money nearly free. The Federal Reserve wants interest rates to remain low, causing bubbles in all other asset classes to worsen. People and organizations, for instance, are buying up real estate, since lending is so low right now. In addition, greater margin debt is mounting up in stocks, cryptocurrencies, and commodities. Finally, because lending is so appealing at these cheap interests, firms are continuing to borrow money in order to grow. However, if interest rates begin to rise abruptly, assets that have been artificially inflated by low rates will begin to decline abruptly.
I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, to borrow houses right now, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon, and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
The Feds can no longer simply raise interest rates, since that would result in a complete collapse of financial assets. And that is why, according to Dalio, the Feds will have to buy bonds to keep this from happening. Dalio believes that by investing in Chinese-related assets, investors may make huge gains before this event happened. The epidemic affected the United States severely, but China had already rebounded. As a result, in order to meet rising demand, American businesses have begun to source an increasing number of Chinese goods. As a result of this, both countries' balance of payments is unbalanced. Each country maintains a balance of payment statements that details all of its international dealings. The current account and the financial account are two components of a balance of payments. All overseas transactions of products and services, as well as transfer payments, are included in this current account. The financial account, on the other side, comprises of investing in foreign investments such as stocks. China's current account isn't even in surplus, as they've been selling items to the US recently. To put it another way, Chinese enterprises have now access to a large amount of US cash. These dollars will have to be used to import US products into China, invest in US financial assets, or convert US dollars to Chinese yuan. In either case, the US dollar should increase against the Chinese currency. This is because when Chinese companies utilize their US dollars to buy products or financial assets, the US currency depreciates as the money supply expands. Furthermore, if there is a surplus of US dollars being exchanged to Chinese yuan, the dollar depreciates. And as a result of this predicament, Dalio feels that Chinese assets are excellent for hedging against US currency inflation.
First best alternatives are other asset classes, but also, let's say China, for example. I think the situation that we're in is quite similar to the going from the late 60s into the early 70s, when there was a different core inflation rate in the United States versus Germany and Japan. It's a different balance of payments situation. We're in basically a balance of payments deficit. They're in a balance of payments surplus position. That means that they chronologically are worried about imported inflation, and there's favorable capital flows. So I think that that's negative for the dollar, particularly against Asian currencies.
In respect of monetary assets in the United States, Dalio believes that we are in a bubble. Because many stocks are selling at premium prices, this bubble makes it harder for investors to locate unique investment possibilities.
I'm more worried about the inflation in financial assets and what that means for returns and bubbles that are developing, because there's a massive amount of liquidity around, and it's being thrown around so that it's a difficult environment for those returns to be justified. I think we're building kind of a bubble. So I think inflation in financial assets and so on is an issue related to liquidity.
Former Treasury Secretary and current Harvard economics professor Larry Summers accompanies Dalio to discuss why he anticipates the economy altering dramatically in the future. Larry compared our current predicament to driving a car at 100 miles per hour on an empty highway. Unfortunately, the highway will not always be vacant, and our vehicle will be involved in a crash.
We're driving our car at 100 miles an hour on a road that is empty right now, but won't always be empty. And I don't know what form the accident will come, but when you're driving at 100 miles an hour, it's probably not actually the fastest way to get where you're going, because you're likely to have some kind of dislocation.
This isn't going to become one of those doom-mongering videos, as I indicated. The fact is that a crash is unlikely to occur. The only thing that is certain right now is that financial assets will have lower long-term rate of returns. People have already made exceptional capital gains during the last year. Nevertheless, don't anticipate these kinds of gains in the overall market to endure. There will be certain stocks that gain significantly, but such chances will be much harder to come by. This is due to the fact that when asset value grows, so do projected rates of return. In the stock market, the link between the future returns and present prices is inversely associated. This is analogous to how rising bond prices result in reduced rates. Similarly, if the stock market increases, so does the predicted future rate of a term. Financial assets will probably produce poorer long-term real returns in totality.
Long-term returns are going to be lower on assets. We've been saying that for some years, and people who've been in asset markets have done very, very well, because even higher capitalization ratios, price-earnings ratios, asset price to rent ratios have been taking place.
When you have the liquidity and you drive down real rates and you drive asset prices up, that doesn't mean they come down. It just means liquidity drives those for their particular future returns.
Investing is more crucial than ever in this complex macroeconomic climate. And with that, the video for today comes to a close. Express your love and support for this video. Click the like button, subscribe, and click the notification bell to be the first to know when a new video is posted. Thank you for taking the time to watch. We hope you enjoyed it and look forward to seeing you in the next video.